every Thursday, we learn what the Fed's balance sheet did, and we were just discussing it. So it's a few whiskers under $4.2 trillion.
That's right.
When you think about the Fed's balance sheet and the fact that they're not doing QE, but they are you shocked to see stocks have performed well?
Not at all. I think we were discussing this. I mean, if you overlay the Fed's balance sheet with a price chart of the S&P 500, I mean, they're moving in lockstep, right? And so it is the only game in town still is the Fed. It's the Fed, it's the easing, it's liquidity. They can call it QE, you can call it fixing the repo problem. But as you mentioned, what it's doing is pumping liquidity in the system. That money has to flow somewhere, and it's flowing into not just stocks, but risk assets all across the U.S.
Now, another issue, of course, is interest rates, and we've just discussed the shadow boxing effect of what central banks do, keeping rates and their thumb on the scale, they're low. But when I look at 169, I don't think, wow, just a couple of weeks ago we had that intraday Iran move down to basically 170. I think that we're now going all the way back to October-ish since we've closed at these levels. I think the close is important. When you look at the market, what do you see?
Yeah, I think what you're seeing is that there's still fear in there. We've had the Iranian issue that we had. Now you have this new coronavirus out there, which I think that's what people are worried about going into the weekend. It's saying, hey, this thing it seems like it's growing and growing. And so there's a little bit of fear there that's going there. But we've been in this range for a while. It looks like we're testing the bottom of the range. As you said, the closes are the most important thing. And right now, if we're not going to go higher until we get through 195. That seems to be the double top we keep seeing. I think of that as August 1st, we broke 2%, right? When President Trump came out, announced this new round of tariffs. We've eased that, but the bond market hasn't responded back to where it was. And so I think what you're seeing here is people are saying the Fed's doing nothing. It's complacency right now. And really, I think people are just buying assets now and just reinvesting for the time being. And a lot of it's the robo-advisors still, right? People had a great year in stocks. You know, let's peel some of that off, put it back in the bond market, and you're seeing it. But capital's flowing to the U.S., and it's because we have high interest rates globally.
Now, we've had a couple of central bank meetings, of course. We had Christine Lagarde. We've had the Bank of Japan. And the comments are very similar. Christine Lagarde is envious of Sweden, but she doesn't look to be pulling negative rates anytime soon. And the Japanese, they don't really see the ill effects of negative rates. I guess that 3.5 decades don't count.
Right, but we pulled out a chart that's I think is very important that you should show to central bankers, and it's the banking stocks. In the U.S., we've hit new all-time highs, right? We've hit back to that the new level. But if you look at the European stocks, they're still trudging the lows. You look at Japanese stocks, they're still trudging the lows. And so it's evident that it's destroying the banking system. So I hope Jay Powell stays there. I hope we get another person like Mr. Powell who says that we should not pursue negative interest rates. And I would wish Bernanke would quit talking about it because it obviously is not good for the overall economy.
No, and sometimes central bankers ought to ride into the sunset.